Hello guys and welcome again to my channel. So what we're gonna talk about today is the working capital management. So we have working capital management. So this is the start of a series. So I'm gonna talk about in this series. The first one is the working capital management in general. The second will be the inventory management. The third will be the accounts receivable management and the cash and cash equivalents management, cash management. The last is the payables management so that we'll be able to master the overall working capital management. But let me start with first the working capital management in general. Okay? So the lessons for the working capital management general starts with first. Again, what is working capital? Again, the working capital is just the current assets minus current liabilities. So, if for example, you have a current asset of 1 million and that you have a current liability of 100,000, then you will have a positive working capital of 900,000. So, since this is positive, and this is a lot bigger than your current liabilities, the current assets is a lot bigger than your current liabilities, then we can conclude that the company is liquid. So the bigger the working capital is, and if the working capital is positive, then the organization or the business organization is highly liquid. So that's the meaning of the working capital. Now, the second lesson, aside from what is this, is it's a review on the working capital. The second is all about the concept, the higher the risk, the higher the return, as well as the working capital management policies. So let's tackle that at the same time. Again, the second that you have to know in this particular working capital management general is the policies of the working capital management, and the higher the risk, the higher the return. The point is, even if the topic is working capital management, it should focus only on this one, but it's not. It's actually talking about the first one. We have the current assets and the non-current assets. So the study includes the non-current assets also, although it is not emphasized in the working capital formula. And also, on the liability side, we have current liabilities and non-current liabilities. So first, let's discuss the higher the risk, the higher the return, and apply it to these elements. So, if the company is still small, as to the assets, it will have higher current assets. And basically, most small companies will tend to have higher cash for its operations. So this is what do we call the implication for small companies having current assets and having higher cash is simply lower return. Because if you invest in current assets, basic and specifically cash, you will have lower return in that. You have to expect lower return. But if you are going to be a big company already, sometimes your current non-current assets will become bigger. And most of the times, if you are going to invest in non-current assets, there will be higher return. Why? Because if you are going to invest in short-term assets, it's less risky. The cash that you have given up if it is in current asset, will be converted back into cash 1 year or less. So the risk is a little bit lower, which is why there is a lower return. Okay? And then, if you are going to invest it in long-term investments, of course, the higher the period of time, the riskier. So there is a higher risk if you're going to invest in long-term assets. So if that will be the case, you should demand higher return. You should expect also higher return. So that's the concept. The higher the risk, the higher the return. Okay? Now, let's take a look at here. When it comes to liabilities, you have to think of the creditors. So if you are going to finance something 1 year or less, you will have a current liability. You have to expect that there will be lower cost of capital or lower cost of capital or lower interest if this is a debt. So an example of a cost of capital is the interest. It is because on the part of the creditor, it's less risky because you are to pay less than 1 year or 1 year. So this is less costly on your part because you have to pay again a lower interest or a lower cost of capital. Whereas if you're going to finance something and you are going to finance it with non-current liabilities, of course, there will be a high cost of capital, higher interest. It is because on the creditor side, they will be extending loans to you for a long period of time, which is much more riskier, more risky, more risky, okay? Which is more risky on their part. So they are expecting higher interest income. So you have to pay higher interest. So more costly. So that is how you are going to apply the higher the risk, the higher the return in this particular elements of the financial statements. And again, even if we're talking only about working capital, the current assets and the current liabilities we have here, in order to understand the higher the risk, the higher the return, the current assets, the non-current assets, current liabilities, and non-current liabilities. Okay? Now, there is an element here which is unusual. We have a fixed current asset. For example, fixed cash balance or the minimum cash balance. That will become a fixed current asset whereby it's a current asset but you will not be able to spend that or use that in the operation. So basically on my part, I am treating it as if it is a non-current asset. Okay. Now, the next is, as I have said, aside from the higher the risk, the higher the return, let's talk about the policies in working capital management. We have the conservative, the balanced, and the aggressive. So I will explain it as simple as possible. So basically for me, if you are to finance current assets, you're going to invest on current assets, it is better that it should be financed by current liability. It is because on the current assets, the benefits to be consumed in the current assets will be short term. So basically, you can have an inflow, for example, also of less than 1 year in the current assets. So if you're going to pay for or invest for current assets, you finance it with current liabilities, because the current liabilities, you're going to settle that also within 1 year or less. So they will be matched, right? So that is what do we call as balanced. And if ever you're going to invest in a non-current asset, like for example, you have to pay for a building, something like that, or construct a building, it should be financed with non-current liability also. That is still under the balance, because the timing of the inflows, if ever, on the investment, and the timing of payment and the non-current liabilities will be matched. Okay, so if you are expected to generate revenues here for 6 years, for example, it should be financed also with a liability of 6 years maturity term, something like that. So that is balanced, and mostly that's the goal of each of the businessman, which is to match their inflows, outflows, the revenues, and the payments of their loans. So this is the goal. However, sometimes you can be conservative, wherein even if you are trying to invest in current assets, for example, you're going to finance it with non-current liabilities. So even though the benefits are very short term, and since you wanted to be conservative, you wanted to uh, likely pay it, your investment here, you're going to get non-current liabilities. So that's very much conservative, because um, under the conservative approach, you are just making sure that you can pay for whatever it is that you have borrowed. Right? That's conservative. And another conservative policy is keeping so much current assets, and keeping so much current assets and keeping so much cash, for example. That's conservative. So what's the disadvantage of that? Let's say, for example, let's exaggerate. You're going to pay for a bond paper and you don't want to pay it for cash. So what you will do is you are going to have a loan for 2 years, for 3 years, something like that. So it is illogical. It is because the disadvantage is, as I have said, the non-current liabilities has a lot of cost of capital or interest. This is more costly. So you have to pay 3 years of interest just for the bond paper. So that's the disadvantage of being so much conservative. And also, in my other example, if you're going to keep a lot of cash in your company, which you don't need anymore, you just wanted to be safe and sure that you'll be able to pay anyone, or if there are needs, cash needs, you'll be able to um, meet them. That's why you keep so much cash. The disadvantage of that one is that you will lose opportunity. Like, if that cash has been invested already in long term, you should have a higher return already. And because you are conservative, you have tried to keep your cash, then that cash loses its ability to get this higher return. Okay? So that's conservative. And the aggressive is something like this. You have non-current asset, which is normally non-current investments and non-current assets are very much costly. You have financed it with non-current liabilities, like you paid for a costly machinery by proceeds related to a short-term loan, for example. So what will happen? Since this is very big and the timing of payment is very short, most of the time, the you will not be able to meet your liability, your payment your due date. It's because this is highly uh, costly. And if you cannot meet it, you're going to force to meet it. For example, like for example, this is 2 million, and this is 30 days. No, 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 6 months. You have loaned 2 million due in 6 months in order to acquire this machinery. So you're going to force yourself to pay within 6 months. And for example, if the whole operations does not provide 2 million after 6 months, what you will do is, in order to pay this, you will have to take a loan, another loan again, which will become more costly because of your aggressive policy. So there are a lot of examples of aggressive policy, like for example, keeping cash at the minimum, like for example, 10,000 only, everything will be invested. So what will happen is there is really a high return if you are going to use the aggressive. Okay, there is a high return. But the problem is there is also a higher risk. Because if ever you will not keep any cash and there is an emergency, for example, or um, okay, there's an emergency for example, related to operations in which if you don't have any cash, the operations will be affected, then that's the risk that you have to take. So aggressive is the definition of higher return and higher risk. The conservative is lower return, lower risk. And the balance is, of course, balanced. So that's, I guess, the very core principle of the working capital management in general. You have to have a knowledge on what is the working capital and the interpretation, if it is positive or high, or if it is negative, or if it is low. And the second one, you have to know the concept, the higher the risk and the higher the return. So you have to apply it here. And the third one are these policies in the working capital management. So I'm going to pause this video first because I'm going to write something. And this is a type of problem that I'm going to write a problem for you. And let's answer the problem based on what we've learned so far. Okay? So here's the illustrative problem so that I will be able to apply what we have learned. So Baby G is starting its own business initially with debt. It wants to start with 15 million total assets, which comprises of the following: temporary current assets 20%, permanent current assets 30%, and fixed assets of 50%. So in that particular in that point of the problem, we're not going to use the below yet. We can already see that as if Baby G is a little bit aggressive, it is because its fixed assets are higher than the temporary current assets, something like that. Now let's move forward. The cost of financing, if ever Baby G is to finance the 15 million using STD or short-term debt, is 3%. And if Baby G will finance using the long-term debt, it will pay a cost of capital of 5%. And you already know what's the reason why the interest rate for both the short-term debt and the long-term debt is just like that. Again, on the long-term debt, on the uh, footstep of the creditor, it is riskier because you have to pay them long-term, right? So they are expecting a higher interest income. That's why you are going to pay a higher interest or a higher cost of capital. So I think you have remembered that in our discussion earlier. Now, the earnings before interest and taxes of BBG is presumed or it's forecasted to be 3,650,000 while the tax rate is 30%. So the requirements for this particular problem is you have to compute the net income under conservative approach, aggressive approach, and the moderate. On the moderate, it has been specified. The moderate is you have to finance the 15 million 40% by short-term debt. It means the 60% of the 15 million is to be financed using the long-term debt. So, number one, under conservative approach, the EBIT will be 3,650,000 less interest. So the interest will be based on where are we going to choose here in the financing. So since this is conservative approach, that means we are trying to make sure that we are to pay 15 million surely. So we are making sure that we are paying the 15 million that we're going to get under the financing surely. So we're going to choose long-term debt, right? So the whole 15 million will be financed by the long-term debt. So if that will be the case, what the interest that we're going to use is 5% times 15 million. So 10% is 1.5 million. So 750,000 is the interest, if I'm not mistaken. So you will have two, this is the net income, but before taxes, 2,900,000. Um, less taxes, which is again 30%. So 290, I don't know, I have to use the calculator. So 2,900,000 times 0.30 is 870,000 minus 29. So net income is 2,030,000. So that's what happens if ever you're going to choose the conservative approach. You will have to pay a higher interest because you have to finance all of the assets using the long-term debt. Okay? Now, if you are aggressive, what will happen is the EBIT will still be the same, 3,650,000, but the interest will be based already on the short-term debt interest rate, which is 3%. Interest is 3% times um, times 15 million, 0.73, 450,000. So the net income before taxes is 3.2 million. Less taxes of 30%. Oh no. So Hello guys, there has been a brownout a while ago. So I have not finished the problem. So let's finish this one. So as you can see, we stop right here in the aggressive side in which the whole 15 million is under the aggressive side will be financed by the short-term debt. So we're gonna use the 3% again times 15 million and we'll have an interest of 450,000. So the net income before taxes is 3.2 million. And during the blackout, I have computed the taxes to be 960,000. So meaning, 3.2 million minus 960,000, we have a net income under the aggressive of 2,240,000. But then again, even if the net income here is much bigger here on the conservative approach, the biggest challenge that Baby G and its management uh, that will that they will be facing under the aggressive is that they have to pay the whole 15 million within 1 year or less. And I think that's pretty difficult if ever this is my company. Although maybe the top management of BBG is very much confident. If we're going to assume that they are very much confident that they can pay the 15 million within 1 year or less, that's why they choose this aggressive policy. Then be it. Okay? Now let's go to the third one. Wait. The third one is the moderate, in which it has been specified that under the moderate, BBG will be financing 40% of the 15 million by short-term debt. So the EBIT will still be the same, 3,650,000, but the interest will be a mixed one. So under the problem, the 40% of 15 million, which is 6 million, will be financed by short-term debt. So times 3%, we're going to use the interest rate to 3%. So 6 million times 0.03, that's 180,000. Okay? Whereas the remainder, which is the 60% of the 15 million, which is 9 million, will be financed using long-term debt. So we're going to use the 5%, which is, I guess that's 450,000. So all in all, the interest that we're going to consider is 180 plus 450,000. That's 630,000. Okay? And then we have a net income before taxes of 3,020,000 less taxes of 30%. 3,020,000 times 0.30, 906,000 minus 3,020,000. The net income for this policy, moderate policy, is 2,114,000. But then again, although under the moderate and the aggressive, you have to pay um, within 1 year or less. Here in the aggressive 15 million, in the moderate, you have to pay 6 million within 1 year. That's their biggest challenge. Under the conservative approach, they don't have such challenge because they have financed it long term. But they are going to suffer for longer years interest of 750,000 because they chose the long term debt, the long term debt financing. So that's it for this particular video. That's for the working capital management general. So next is we're going to talk about the inventory management. I think the inventory management should be the next topic. It is because it's more relatable than the receivable management, cash management, and the payables management. And of course, we're going to use first the inventory management because if you understand already the inventory management, you'll be able to understand receivable management, cash management, and payables management. And that is just my personal opinion. So that's it for this video. See you on the next episode.